When doing foreign trade, you already have some US dollar income. When I bought a US dollar fixed deposit with the intention that, barring any emergencies, I won't convert it into RMB.
Due to expected depreciation pressure on the renminbi, Chinese companies are hoarding US dollars to avoid exchange rate losses. Renowned Hong Kong economic commentator Luo Jiacong recently stated that in the future, the Chinese government will guide the renminbi to depreciate significantly, unlike the gradual depreciation seen last year. According to official data, China's trade surplus steadily increased in the first quarter of 2024 when measured in US dollars, a surplus that has long been considered the driving force behind the renminbi's strength. Moreover, China's GDP grew by 5.3% in the first quarter, exceeding expectations and representing a 1.6% increase from the previous quarter, a strong start to the year. With a significantly expanded trade surplus and accelerating GDP growth, why is the renminbi not only failing to appreciate, but instead depreciating? From around 6.7 renminbi per US dollar at the beginning of 2023 to the current level of around 7.25, a 5% drop, the renminbi's exchange rate has recently hit a 5-month low. Recent rumors in foreign trade circles are that exporters are reluctant to settle their foreign exchange. If the US dollar cannot be converted into renminbi, its impact on the economy is very limited. So why are Chinese exporters hoarding dollars? On the one hand, exporters are adopting a wait-and-see attitude towards the exchange rate, with a large number of them believing that the renminbi will continue to decline. On the other hand, they are influenced by the increase in US dollar deposit rates. Recently, US dollar deposit yields have reached their highest level since the financial crisis. By choosing to deposit US dollars in offshore accounts to earn high interest returns and waiting for better exchange rates before converting, exporters are now earning foreign exchange income, while domestic exporters are facing a depletion of regular capital inflows. The strength of the US dollar inevitably leads to capital outflows in renminbi. In fact, since the beginning of the year, the overall rate of foreign exchange settlement in China has been consistently low, indicating that most companies have not converted their earnings in US dollars into renminbi. What is the purpose of hoarding US dollars? The majority of profits earned by Chinese exporters are in US dollars. After settling a portion for normal operations, these foreign trade companies prefer to hold US dollar deposits. Analysts at China Construction Bank estimate that in February, only 51% of export earnings that were deposited as dollars were converted into renminbi. Another crucial question is how much of their dollars earnings have been transferred out. Many have found secret ways to transfer US dollars abroad. From the increase in foreign exchange deposits and the pessimism of foreign trade companies towards the renminbi, it appears that these companies are not confident about future foreign orders. Alvin Tan, head of Asian foreign exchange strategy at RBC Capital Markets in Hong Kong, recently told Reuters, the rate differential between the US and China is the most positive since 2007, and I think this powerful fundamental fact is enough to explain why Chinese exporters are reluctant to exchange dollars for yuan. In the Changsha region, some banks have openly sold US dollar deposits with an annual interest rate of up to 5%. This risk-free rate is almost irresistible. For example, converting 10 million RMB into US dollars, which equals $1.38 million, and depositing it into a US bank with a 5% annual interest rate would yield $1.45 million after 1 year. With the current renminbi to US dollar exchange rate at around 7.24, if the renminbi depreciates to 7.4 against the US dollar after 1 year, it would be equivalent to 10.7 million RMB. This means earning 780,000 renminbi without doing anything for a year. Yu Zhuochen, director of Gore-Tech Inc., a Chinese electronic equipment manufacturer, mentioned at a forum in late March in the coastal city of Ningbo that exporters are earning while lying flat, referring to their foreign exchange income. When these business owners and wealthy individuals profit from the exchange rate and interest rates between the renminbi and the US dollar, ordinary Chinese people suffer. Why? Because of the depreciation of the renminbi, purchasing power decreases, and prices will further rise. Those who rely on their salaries to support their families will see their wealth evaporate. Certainly, the depreciation of the renminbi is not only due to domestic companies holding onto US dollars, but also because the Federal Reserve's hopes of interest rate cuts in the first half of 2024 have dimmed. This, coupled with the People's Bank of China's loose monetary policy, will exacerbate currency weakness and capital outflows. On April 18th, the People's Bank of China will set the midpoint at 7.102 against the US dollar, raising it by 5 basis points. This means that with the US dollar generally strengthening, the renminbi will further depreciate. According to a recent Bloomberg report, China unexpectedly weakened its defense of the renminbi as pressure from the strengthening US dollar and weak market demand sentiment pushed the exchange rate towards a policy red line. Chinese observers have been closely monitoring the point to look for signs of Beijing's desired direction, to look for signs of what Beijing intends to do with the exchange rate. Recently, the exchange rate has dropped to the edge of the trading range. Richard Franulovich, head of foreign exchange strategy at Westpac Banking Corp, said, "The People's Bank of China is bowing to reality, with dollar broadly higher and onshore dollar demand surging. They obviously want to control and contain the move, though, so they're guiding yuan lower in a moderate and steady fashion." What is the renminbi's midpoint exchange rate? Recently, the financial social media account Money Talks posted a video on Douyin.
Hard to imagine, right? Recently, the renminbi exchange rate has been very strange. Both offshore and onshore renminbi are around 7.2 against the US dollar. But the central parity rate has been set at below 7.1 for many days. Many people have asked me what's going on. In fact, this is a strong intervention by the central bank in the renminbi exchange rate. Why is this happening? How is the central parity rate determined? The central parity rate is not the midpoint between offshore and onshore rates. The central parity rate is determined before the opening of the market. All market makers of the renminbi exchange rate, which are actually China's major banks, are required to submit a quote. Then the highest and lowest quotes are removed, and the middle rate is taken. That's how the central parity rate is determined. In order to protect the renminbi exchange rate, China has another important measure, which is that the central parity rate cannot deviate by more than 200 basis points each day. With this measure, it is found that after setting the central parity rate, the depreciation space for the renminbi is limited. Even if the renminbi depreciates further, it will not reach 7.3, so the central bank has been controlling the renminbi.
China has a unique currency exchange rate system with parallel onshore and offshore rates. The renminbi traded in the onshore market is known as CNY and is directly constrained by the central bank's midpoint rate. Current trading rules stipulate that the daily fluctuation range of the onshore renminbi spot rate cannot exceed 2% of the midpoint rate. The renminbi traded offshore is known as CNH, and its trading market is mainly in Hong Kong, with other financial centers such as London and Singapore also involved. Its exchange rate fluctuates entirely based on market supply and demand. Its offshore renminbi needs to be converted into onshore for use in the legal currency. Approval must be obtained from the central bank and the State Administration of Foreign Exchange. The central bank's setting of the renminbi's midpoint rate not only affects the onshore renminbi, but also impacts the offshore renminbi's exchange rate. Apart from the 2% fluctuation range limit, the midpoint rate also serves as an important policy signal for the future trends of both onshore and offshore renminbi, guiding financial market participants' expectations. Recently, the speed at which the People's Bank of China is printing money has been astounding, with M2 surpassing the sum of the United States and the Eurozone. Financial data released by the People's Bank of China for the first quarter of 2024 shows that by the end of March, the broad money supply, M2, was 304 trillion RMB, an increase of 8.3% year-on-year. During the same period, the scale of social financing was 390.3 trillion RMB, an increase of 8.7% year-on-year. The cumulative increase in the first quarter was 12.9 trillion RMB, at a historically high level for the same period. M2 includes the general public's and enterprises' demand deposits, as well as less liquid time deposits, constituting the broad money supply. With M2 reaching 304.8 trillion RMB, Chinese people are speculating about where this money is going. Some comments suggest that the central bank's continued loose monetary policy may not be solely to stimulate the real economy, but rather to a larger extent to maintain debt rollover. Behind M2 is a debt of over 350 trillion. As the central bank releases money and M2 expands, it largely represents funds lying idle and explicit debt continuing. Whether this can ease hidden debt, pressure on real estate companies, and weak financial institutions is worth pondering. Chinese financial and tax expert Ma Jinghao previously questioned why, in 2022, China printed a total of 28 trillion RMB, equivalent to the annual total of the United States, Japan, and the European Union, while China's GDP is only 70% of the United States. He said, with so much money printed, why haven't the stock market, housing prices, and consumer prices risen significantly? Regarding the rapid growth of the broad money supply, renowned Chinese economist Fan Gang has proposed the concept of a liquidity black hole, meaning that no matter how much money is injected, it cannot have a significant effect on economic recovery. China's economic recession, withdrawal of foreign capital, and reduced export trade will all lead to a depreciation trend of the renminbi, posing difficulties for the Chinese Communist Party in controlling the exchange rate. A recently published excerpt from Xi Jinping's excerpts on financial work shows that in October last year, Xi Jinping, at the Central Financial Work Conference, called for the central bank to start buying government bonds again. This sparked widespread controversy. Market analysis suggests that Xi Jinping's speech seems to imply that China will start its version of quantitative easing. Mike Sun, a North American investment advisor, believes that while the Bank of Japan's quantitative easing policy aims to escape deflation, the Chinese government may hope to use quantitative easing to solve the problem of excessive debt at the central and local levels. According to financial data provider Wind, as of the end of 2023, the total amount of interest-bearing debt of local governments in China was nearly 40 trillion RMB, which is the only publicly available data. The actual data is likely to be even more staggering. Previously, the main source of income for local governments in China was revenue from land sales and taxes related to real estate development, known as land finance. However, with the collapse of the Chinese real estate industry, local government finances in China have fallen into difficulties, and government bonds are considered to be an important means for the Chinese Communist Party to make up for the shortfall in local finances. Mike Sun stated that since Xi Jinping came to power, he has publicly stated that he will not resort to flooding the economy with liquidity. However, in reality, a large amount of currency far exceeds previous levels. If the People's Bank of China continues to buy government bonds in the secondary market, the renminbi will face even greater depreciation pressure in the future. Professor Xie Tian of the Moore School of Business at the University of South Carolina said recently that many current governments advocate Keynesian economics, which is essentially about printing money. In fact, when money is printed to create inflation, the government is seizing social wealth. The currencies we have now are sovereign currencies, meaning that governments have the power to print money. If a government is relatively responsible and the central bank is an independent institution, there may be some constraints on printing money. However, some central banks, like China's, are actually under the jurisdiction of the State Council, so they will print money desperately to meet the government's political objectives. Printing money first benefits the government, and wealthy individuals can get very favorable loans, but most ordinary people will suffer. Xie Tian said, "Why is it that China has printed so much money, but there seems to be no inflation? Some people now believe that China is actually experiencing deflation, which is actually a false proposition. China does not lack inflation, it's just that its calculation method is controlled by the government. In fact, what the Chinese Communist Party reports, such as the prices of food, may not have increased by much, but the overall prices are actually rising." Another reason is that after the Chinese Communist Party prints money, it does not distribute it to consumers like the United States has. After the pandemic, the money printed by the US government was directly distributed to low-income and middle-income people, and to small business owners who had to stop production due to the pandemic. Once this money reached the people, they could buy things with it, so the prices went up. So, will the new round of renminbi depreciation continue in the long term? China's economic downturn and the trend of the renminbi are important indicators that the outside world is watching closely. Recently, He Wei, a Chinese economist at Longzhou Jingxun, told the media that he expects the renminbi's decline to be relatively slow, but may test 7.3 against the US dollar before the end of June this year. Analysts from Malayan Banking, Central Chartered Bank, and DBS Group have also expressed similar expectations, suggesting that the RMB's exchange rate may decline to around 7.3 in the near term. A Shanghai banker dealing with enterprises said that some of his clients now see 7.3 as a sign to sell US dollars. A report released by Bank of America Corp on April 12th showed that shorting the US dollar against the renminbi is the most favored China trade by investors recently. Respondents said that the onshore renminbi against the US dollar may fall to between 7.3 and 7.4. The continued depreciation of the renminbi has attracted market attention. Professor Xie Tian said, the depreciation of the renminbi's exchange rate is actually related to the decline of the Chinese economy. We know that if a country's economy is strong and its exports are strong, it will bring pressure for its currency to appreciate. On the other hand, if exports decline, it will bring pressure for the currency to depreciate. So the decline of the Chinese Communist Party's currency is actually caused by the pressure brought about by the decline in the Chinese economy and exports. Xie Tian believes that there doesn't seem to be any hope for a short-term recovery in the Chinese economy. The Chinese Communist Party knows that the classic drivers of its economy have failed, but now it has introduced new drivers: electric vehicles, lithium batteries, and photovoltaic products. Lithium batteries and photovoltaic products are currently in trouble, and electric vehicle exports are facing an immediate anti-dumping investigation and sanctions from the European Union. The U.S. Treasury Secretary recently visited China to discuss possibly banning Chinese electric cars to be exported to the United States. So the new economic drivers have run into a wall. So, without these new growth points, it seems the Chinese economy will not improve in the coming years.